Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, March 31st, and I'm recording this from our brand new studio in Purchase, New York. The U.S. equity market's recent correction and a partial retracement of those losses has once again raised the questions of whether or not we should buy the dip. As you may know, for most of the post-COVID cycle, that strategy worked. And while we understand investor temptations to again buy the dip in the passive market cap weighted index, such a strategy may no longer be as effective. The events and data from the last 90 days suggest to us that the prior market narrative supporting the bull case is broken, requiring a new approach to portfolio positioning. Consider first the shift that has occurred in the Federal Reserve's policy stance. The focus has moved away from the fourth quarter's easing campaign toward a patient policy pause, where inflation risks remain in the spotlight and only one or two cuts are expected by year-end. Also, the Fed's recent surprise announcement to taper its balance sheet runoff is a notable development. This strategy does little to address inflation concerns or to support small businesses and consumers who remain desperately rate sensitive. Meanwhile, it helps U.S. Treasury's efforts to contain the 10-year Treasury yield and adds market liquidity that could support financial sponsors, which raises the issue of central bank independence. Second, the secular growth story of generative AI and the exclusive dominance of the Magnificent Seven has also been broken. Not only have those names been underperforming the broader index for some time now, but they're experiencing decelerating growth and negative earnings revisions, while questions grow about the ultimate returns on their surging capital spending budgets. What's more is those companies are broadly global and have more than 52% of their profits coming from outside the United States. That means they face headwinds not only from potential tariff policies, but also from U.S. dollar volatility. Now, all that said, and despite extremely high policy uncertainty, we remain focused on what we see as the two most important factors for 2025: the durability of an economic soft landing and earnings achievability at a company's specific and idiosyncratic level. And we see reasons to be selectively constructive here. Consider that fourth quarter final GDP growth was solid, with consumption still expanding at a 4% rate in real terms. Labor markets remain stable, and data on areas like durable goods orders and industrial production suggest positive economic activity. While such data may be reflecting some pull forwards related to tariff concerns, there is a cause to believe that the economy is still growing. This, in our view, creates opportunities among fairly valued stocks, especially in healthcare, financials, industrials, and consumer media. With all this in mind, as we enter the second quarter, we suggest maximum diversification, active risk management, and security selection. There is no need to chase market beta. Instead, consider using market volatility to rebalance across asset classes, regions, and sectors. In the U.S., equal-weighted indices are the recommended approach for accessing passive risk-adjusted returns for now, while active strategies, including hedge funds, are preferred for equities and credit. Make sure to have exposure to real assets. As always, thanks for listening, and for more information on portfolio strategies and financial planning, please reach out to your Morgan Stanley financial advisor.